I added a new dividend stock to my dividend cash flow portfolio. And it's not a dividend stock many people talk about. However, there are some very compelling reasons why this dividend stock makes a lot of sense in my portfolio. We'll talk about the business, the dividend yield, the dividend growth rate, the dividend history, dividend safety, and of course, cash flow, so that we can answer the biggest question of all. Does it make sense for you? There is a lot of volatility in the stock market right now. It seems like the S&P 500 is down day after day after day. And in my opinion, in times like these, dividend safety is paramount. The true value in owning dividend stocks is you don't need to worry about the day-to-day price fluctuations of a company. Stock goes up in value? Okay, great. Stock goes down in value? Not a problem, because the dividend is always being paid. And in the case of companies I like to buy, the dividend increases every single year. So while I usually look at companies that have been paying increasing dividends for at least 10 years, during times like this, I like to increase that threshold to 20 to 25 years or more. And furthermore, I like to see that dividend payout ratio based on free cash flow be stable and not have lots of fluctuations when times get tough. And to do this, a company has to have a wide moat, meaning that their business doesn't have a lot of competition that impacts their bottom line on a monthly or annual basis. So the company I opened a brand new position with is Medtronic PLC, ticker symbol MDT. They're in the healthcare sector for the economy, and they've been paying increasing dividends now every single year for 45 consecutive years. This makes them a dividend aristocrat. And when I say they're in the healthcare industry, really, they make medical devices. Devices to help with lung cancer, different types of surgery, including brain surgery or hernia surgery, treatments for ear infections and bone conduction hearing therapy, heart and vascular devices, and spinal fractures and lumbar spinal stenosis. And those are just devices for patients. They also make devices for healthcare professionals, surgical technology, cardiac rhythm, cardiovascular, diabetes, digestive, ear, nose, and throat, neurological, patient monitoring, respiratory, spinal, and orthopedic. Medtronic has four main segments: their cardiovascular portfolio, the medical surgical portfolio, the neuroscience portfolio, and the diabetes operating unit. And when you look at net sales with respect to these four segments, there's a lot of stability. Really no changes in the percentages here. 36% cardiovascular sales, 29% medical surgical, 27% neuroscience, and 8% or 7% in diabetes. Additionally, half their sales come from the United States versus 32% in non-US developed countries and 17% in emerging markets. Now, you guys know I'm a huge fan of dividends, but at the same time, there are other ways to return cash to shareholders, including share buybacks. When a company buys back shares, they are reducing the amount of shares outstanding and increasing the value of the shares you hold, which adds more value to the stock. Now, generally, a company should do this when prices are low, as opposed to buying back shares when they're expensive. And that's exactly what Medtronic did in 2022. A total of $5.5 billion in fiscal year 2022 was returned through dividends and net share repurchase. They're a dividend aristocrat, and it says here they paid $3.4 billion in dividends, and they repurchased over $2.5 billion of stock in fiscal year 2022. And 2022 was a great year to do so. In 2021, the price of Medtronic was between $120 and $125 per share, and in 2022, it's been below 100 the majority of the time, which means they bought the shares back at a good value. So some of the great things I like about Medtronic from a dividend perspective: their dividend growth rate, 8.4%, 8.7%, 8.4%, and 10.2% over the past 1, 3, 5, and 10 years. This not only beats the long-term historical inflation rate of 2 to 3%, but it's essentially matching right now the inflation we're experiencing, which means we're not seeing a reduction in our value of our dividend year over year as a result of inflation. Current dividend yield, 3.55% against a historical dividend yield of 2.25%. Which means that their shares are on discount right now by 37% based on their historical 5-year average dividend yield. Medtronic offers weekly options, and I'll talk about that in a bit. Their dividend payout ratio based on free cash flow is 63% based on 2021. And over the trailing 12 months, it's only 64%. And the majority of companies have seen an increase in their free cash flow dividend payout ratio, but the rise in MDT is very negligible. And take a look at their historical free cash flow per share over the past 10 years, ranging from a low of $3.14 per share to as high as $4.93. Here's my portfolio. You can see that I added 200 shares of Medtronic, and I immediately, right afterwards, sold 2 call options expiring on December 30th, 2022 at a strike price of $79 per share. By selling covered calls on Medtronic, I have the ability to 2x or even 3x my cash flow on the stock. Let's go down to a 30-day option here just as an example. I don't usually go out to 30 days, but we'll use it as an example. Let's look at this 26 delta right here, expiring in 32 days on January 20th. Strike price of $80. 26 delta, maybe 27 delta. The bid and ask is $74 and $82 here, 74 cents versus 82 cents per share. Let's assume 74 cents per share. We'll take 0.74, multiply that by 12, okay? Assuming we can do it 12 times a year. We know that we're making an assumption by doing that, but just run with me here. We're talking about the best case scenario. That is $8.88 per share. Then we add in an annual dividend of $2.72 per share plus 2.72 per share equals total cash flow per year of $11.60. $11.60 divided by 76.97 equals 15% yield. That's instead of 2 to 3%, which is 4 to 5x cash flow just by selling covered calls. Even if you just double your cash flow from 3% to 6% or 9%, is that not a good deal? Now, the one big downside for Medtronic is they're based in Ireland, even though they primarily do business in the United States. And because of that, there's an Irish dividend withholding tax, or DWT, of 25%, which kind of sucks. But you can actually claim a tax credit on your tax return every year and get that money back dollar for dollar. Now, there is some time value loss because you can only claim it at the end of the year versus the time the dividend is received. But for me, since I'm going to generate the majority of the income out of this stock from the actual option premium, this is not that big of a deal to me. But I can appreciate why that might be a deterrent for some investors out there, especially in retirement accounts where you may not be able to apply for this credit. So make sure you talk to your tax advisor before you buy Medtronic in a retirement account. So Medtronic, great dividend yield, great dividend growth rate, very stable payout ratio based on free cash flow, the ability to 2x, 3x, even 5x your income by selling covered calls. Lots of great things happening with Medtronic. Make sure to leave your 2 cents down in the comments below. Let me know what you think about Medtronic. Is it in your own portfolio? Are you thinking about buying it now as a result of this video? Remember, I respond to all comments received on the day I post a video. That's all I got for you guys in this video. Have a great rest of your day, and thanks for watching.